So everyone, my name is Nick. I am one of the co-founders of Syla. So Syla is a crypto tax software solution. If you have cryptocurrency investments, you can sign up to our platform, import your data, and calculate the tax outcomes. So what we're going to go through today is a little bit of an introduction of how capital gains calculations for cryptocurrency are done. And then we're also going to introduce you to some ways to actually save on tax as well. So something you maybe haven't heard of before, but some strategies where you can do that. We'll also do a quick little demo of how Syla works. So show you practically how you can actually import your transaction data, calculate the tax outcomes, and make that process really easy. So yeah, just a quick disclaimer. Obviously, as we do this, all the information is quite general. So I haven't considered anyone's personal specific situations. Please don't take it as tax advice. But if you have questions later, I'm going to do the best I can to answer those as well. So please save them, hold on to them. At the end, we're going to do some Q&A as well. So what is Syla? As I mentioned, it's crypto tax software. We're a 100% Australian-owned company. We're focused on tax here in Australia. We have a live chat support, and all of our tax logic's being designed by tax professionals in Australia. Syla is for crypto investors. So the main sort of value that you might get out of using our software is around affordability. So we are the most affordable tax software solution. If you might be looking at some of the others, if you have up to 10,000 transactions, it's still $59 for an annual subscription to use our software for the year. You can import all your data, calculate the tax outcomes. We're purpose-built for Australian tax law. And we also have our, what we call LTFO, or lowest tax first out. That's a special tax algorithm, which I'm going to explain a little bit about, but you can actually optimize to have lower tax outcomes. So what is crypto tax? Some of you may still be asking this question, right? Is crypto even taxable? It's actually really simple in Australia. You can read the Income Tax Assessment Act. It's about 5,000 plus pages of tax law. It's pretty dry, but really it boils down to if in some way you're an Australian taxpayer, you increased your wealth, there'll be some way that we capture that increase in wealth, which is then taxable. And that includes cryptocurrency investments. So what is crypto? For tax purposes, it's something that's called a CGT asset. So that's similar to shares. And basically all cryptocurrency is CGT asset. For CGT assets, where you're undertaking an investment activity, so you're investing in cryptocurrency, it's subject to something called capital gains. So that's capital gains, capital losses. If you've held the investment for over 12 months, then you'll be eligible generally to the CGT discount, which is a huge tax incentive, cuts it in half. Or if you're a self-managed super fund, you get a 1/3 discount. So that's sort of high level. When does a capital gain occur? You only have to calculate CGT and declare it when you actually sell or otherwise dispose of your cryptocurrency. So if you, for example, purchase Bitcoin, but you don't sell it, it doesn't matter that it's gone up in value, you won't have to declare it until you actually sell it. What gets people confused though is that it's not just sales, it's disposals. So whenever you swap crypto for another cryptocurrency, if you gift your crypto to somebody else, if you pay some fees in cryptocurrency, all of those are called disposal. And that's when you have to calculate a capital gain or a capital loss and also need to declare it as well. The rule of thumb is basically whenever you held crypto and now you no longer do, that's a CGT event and you have to calculate a gain or loss and declare it. So now I'm going to explain to you how a capital gain is actually calculated. It's a really simple example. So you can imagine that you have $10,000 cash that you put onto an exchange platform, and then you use that to purchase 1 Bitcoin, right? So when you do that purchase, when we do the tax calculations, we say that you now own 1 Bitcoin, and the cost base of that Bitcoin is the $10,000 that you paid for it. When you later sell the Bitcoin, or in this example, you've sold the Bitcoin now for $50,000, which is fantastic, right? The proceeds from the sale is how much you got for it. That's the $50,000. So now we have the $50,000 in proceeds and the $10,000, the original cost base. And then at the end of the financial year, you're going to look in your portfolio and you now have $50,000 cash sitting there. When you do the tax calculation, to calculate the capital gain, you take the $50,000 proceeds and subtract the $10,000 cost base. This is your capital gain, $40,000. This is essentially what you'll declare on your tax return. If you have other CGT events, you'll have to add them all up as well, but this is fundamentally how that calculation is done. In this example, because it was held for less than 12 months, you won't get that eligibility to the CGT discount. So that's the full amount that you'll have to declare. Now, the next sort of thing that people start to think about with the capital gains is what we call like the parcel dilemma. And this is the introduction to how we can actually save more tax as well when you do CGT calculations. So it's the same sort of similar example. You take $10,000 cash and you purchase one Bitcoin. So you still have that same cost base of $10,000. But then imagine you purchase another Bitcoin. But in this case, you paid $40,000. So the cost base is $40,000. And then you decide to sell the Bitcoin. And the proceeds from that sale is $50,000. The question is, to do the calculation, you have to take the proceeds, which is $50,000, and then subtract the cost base. The question is, which Bitcoin did you sell? Did you sell the first Bitcoin that you purchased for $10,000? Or did you sell the second Bitcoin that you purchased for $40,000? And depending which one you choose, it's going to have a really big difference in the tax outcomes. If you pick the first one, then the gain that you need to declare is $40,000. Whereas if you pick the second one, the gain is only $10,000. So it's much better, obviously, to pick that second parcel. That's when it comes into the parcel methods that you might have heard about before. So this first one is the most common. It's called first in, first out. It's like an algorithm or a method of choosing which parcel to use. If you pick the first one, then that's the first in, first out. If you pick the last parcel that you purchased, that's called last in, first out. If you pick the parcel with the highest cost base, that's called highest in, first out. And then if you pick the one that has the lowest tax, we call that lowest tax first out. So we look through all the purchases that you've made historically, we check the cost base, and we check whether it's eligible for the CGT discount, and then we pick that one which will have the lowest net tax outcome for you. So, depending if you've made a lot of purchases through the year, you can actually save a lot of tax by choosing a different parcel matching method. So this is one of the ways that we optimize for lower tax outcomes in Syla. The way the software works is, so if you sign up for an account on Syla, we connect to the different exchange platforms that you use. So that's either done through an API data feed where you give us read access permission to pull your transactions in, or you can export a CSV file that you can drag and drop into our software, and then all your transactions come through. And then the tax calculations are done automatically for you. Our major partners, so we've partnered with a number of exchanges in Australia, including CoinSpot, CoinJar, B2C Markets, as well as some local exchanges here in Queensland, Digital Surge, CoinStash, and also CryptoSpend. And we obviously support a number of other integrations as well. So we have support for a lot of the global platforms also. So it doesn't matter sort of which platforms you have, there's a good chance we already have support for it. I'm now going to switch over to show you a practical demo of how we actually do those calculations in the software, so you can start to get a little bit of a feel about how that works. Might need some AV support. Just need to switch to the other screen. The browser, do you know how to switch it? We're just going to set up so that we can run the demo, but maybe we can take a few questions now. If you have sitting on any tax questions, please pop your hand up and I'll try and answer anything that you might have. I think, however, they picked it on the TV.
Thanks for the opportunity. My question is, because many investors keep their saving mostly in stable coins in difficult times, so like now when the market is not that good, does this include swapping for stable coins?
Yeah. Yeah, so the question is, like, if you swap to a stable coin, is that still a taxable event? The way you need to think about it is, it's not about the stable coin, it's about the crypto investment that you had before. So let's say you had your Bitcoin and you swapped it for the stable coin. It's actually about the fact that you got rid of the Bitcoin. That's the CGT event. So it doesn't matter what you swapped it for, whether you sold it for cash, you sold it for a stable coin, you swapped it for another cryptocurrency. The fact that you had Bitcoin and now you no longer do, that's the CGT event, and that's what you have to calculate the gain or loss on. So yes, the answer is, like, if you swap to a stable coin, that's still a taxable event. And then the stable coins themselves are also considered a CGT asset. So if they go up or down in value relative to Australian dollars, that's also a capital gain or loss generally.
Hello everybody. My question is, if you are, say, an Ethereum miner, or you used to be, or mining other kind of crypto, Bitcoin, whatever, and you never sell, does that mean you never have to claim or tell the tax department anything at all until you finally sell on exchange?
Good question. Okay, so we're good now. Yeah, it's another good question. So it's about, there's two questions there. One about the mining activity, and then about what you do with the crypto that you mine. So mining is not a source of CGT. It's actually going to be normally classified as ordinary income. So when you mine that crypto, you have to calculate the Australian dollar value of it, and that gets declared as income on your tax return. And the next question is, what do you then do with the crypto that you mined? Let's say you just hold it, right? If you just hold it and don't do anything else with it, you're right, there's not going to be any CGT events that you would have to calculate the gain or loss on. So until you actually eventually sell it, or swap it for something else, or dispose of it in any other way, you won't have any capital gain or loss to declare. The questions, I'll take more at the end. I'll do the demo quickly, and then we can come back to the Q&A. Okay. Yeah, apologies, some of the screen doesn't quite come across, but hopefully you can still see everything okay. So this is what Syla looks like when you first log in. I'm just going to quickly jump into my account and show you how we actually sync some data into the software. So this is like the dashboard of everything that you see. Normally the first thing that you would do is go to the data sources page. So a data source is like your exchange or wallet, or wherever you have crypto activity. You come up here, you click add data source, and then you can sort of scroll through here, or you can type in here, whichever exchange platform that you've used. And then you can find the one and click it. So for example, I'm going to show you sort of my test account that I use on CoinJar, just to show some practical example. We normally have two ways that you can do the import. On CoinJar, it's super simple. It's actually done through a connect. So you just like click the connect button. Okay, perfect. So I thought I had logged in before this, but I haven't. So I'm going to have to quickly do this, just 2 seconds. Okay, perfect. So it'll sometimes, for this particular connection, it's quite specific. So it'll ask you to sort of log into your CoinJar account if you're not already logged in, or otherwise you can log in separately. And once that's done, you can just click sync. And what's happened is when you click connect, you've actually given Syla permission to go to your CoinJar account and request all of your transaction history. When you set up that connection, we only have access to read your transactions. So we never ask you to give us permission to like trade on your account, right? Because we don't want to be placing trades or withdrawing your crypto. You just give us read access to view your transactions. We also always support, and I'll show you in a second, like a CSV import. So if you're not comfortable giving permission like that, you can still export a CSV file that you can upload into Syla. But you can see here that the import's been successful. So you just click close. You can see here now that the CoinJar account's been added. There's 97 transactions. You can come down here and scroll through it. You can see the different assets that I hold on that account, the different balances and the current value. On CoinJar, there's actually two platforms they have, CoinJar and CoinJar Exchange. So I'm now going to show you the second way that we normally get transactions into Syla, and that's through what's called an API key. So a lot of platforms, the way that it works is you generate something called an API key. So you would log into your CoinJar Exchange account in this example, follow these instructions that we have to generate a read-only API key. It's sort of like a password that gives us permission to read your transaction history. So I've already done that process of generating the keys. So I'm just going to copy and paste those. And click sync. And once again, Syla is going to your CoinJar Exchange account and requesting all those transactions, and the import is done. Once again, there's only a few transactions there, but they've all come through. It's a bit funny, on CoinJar, your balance can actually go negative, and that's actually what's happened here. Syla's pulled that information in as well. And then I'm going to add one more data source. This time I'm going to do an example for CoinStash and show you how a file import works. For this platform, we only support a file import. So once again, you would follow those instructions, log into your account, export your CSV file, and once you've done that, you can just drag and drop those files into Syla. So I've just added the two files that you can get from CoinStash. You click import, and those transactions are going to come in as well. So it doesn't matter how many sort of data sources you have, you can add all those in. Once you're done, you can view your transactions here. So you can sort of go through them. If you click on these, there is more information about it, but you don't always need to do that. And then finally, you can go to the tax reports page, select the financial year that you want to generate a report for, and then you can download that here once you've paid for a plan. So that's just going to download the report, and I'll show you a quick little look of how that actually works. Excellent. So this is the sort of final report that you get. You have two choices with this report. One, you can use it yourself to finish preparing and lodging your tax return if you do your tax return yourself. Otherwise, you can take that to your accountant, you give them a report, and they'll know what to do with it. But if we look through here quickly, I'll show you how it looks. The most important section is here, where it gives you the summary. So when we talked about earlier how we do those capital gains calculations, Syla's automatically done all of that. So all your trades, all your swaps, we've calculated all those capital gains and losses, and then we summarize them here. If you have any foreign currencies, we'll list them here. And if you have any other sources of income, like the mining, for example, that would also get listed here. We give this convenient summary that you then use to plug into your tax return. And that's basically how Syla works. We can switch back now to the Q&A. Well, we can ask that as a question in a second. Yeah, can we switch back to the presentation? I'll just put up the offer as well.
Presentation.
Back to the presentation. Oh, actually, I can just probably
That's
do
it.
that.
You got it. Yeah.
Let's pop this up. Awesome. Okay, so we're going to do Q&A now. We also have sort of an exclusive offer as well. If you do sign up and you purchase a plan, when you go through the checkout, if you enter in TaxStars, you'll get a 30% discount across any of our plans. Cool.
Can I ask that question?
Yeah, absolutely. Any questions are open. I'll give it a shot.
My question is about
other exchanges or wallet companies like Exodus. Does Syla go do that, or you need to put your own CSV?
Is there a second mic, or we just pass it? Yeah.
Sorry, guys, here to stop talking.
Yeah, sure. There's like a lot of different exchanges, a lot of different wallets, and that's one of the biggest challenges for a software product like us. We do support Exodus, so you can log into your Exodus wallet, do a CSV export, and that's what you would import into Syla at the moment. So on Exodus, you have like your deposits, withdrawals, you can do those crypto to crypto swaps as well. All that information should come through.
I feel like they're recording me for the question.
It's got to be a good
so
one
I was just
now.
wondering if your software supports you if you actually trade as a business as opposed to trade on capital gains assets. And if it does support trading as a business, how does it treat opening stock values, closing stock values? And sorry to hit you with 3 questions in one, but also things like liquidity calls and when you have like off-chain transactions, does it have a methodology of dealing with those sort of things? So like for example, if you're using say a step-in style app and you've got transactions going in there, all of them are CGTable, so you're minting tokens daily, you're potentially selling, swapping, but none of them are captured on chain. But you would capture the difference in your token value from when you send to when you receive back. So sorry to hit you with 3 questions, but just save on the mic back and forward, see how you go.
Yeah, straight off the bat. I like it. Okay, good question. So, when we talk through this presentation, like most of you in the room are what we call like an investor. So when you purchase cryptocurrency, it's probably for an investment activity. That means you bought Bitcoin, you want it to go up in value, and then you'll sell later. So that's called investment, and that's subject to capital gains and losses. What the question is sort of talking about is, okay, what if I trade for profit? Or what if I'm actually undertaking a business activity? If you're undertaking a business activity, it's not going to be treated usually as capital gains. It's going to be use a different set of rules called trading stock rules. The calculations are actually very different. To answer the question, we don't support trading stock at the moment in Syla. It's something that we do want to introduce. It's in the roadmap, but it's not available at the moment. You're right, you do have to do a valuation of opening stock, of your closing stock. You have to calculate your revenue, your purchases, and declare all of that. It's done very differently. Yeah. The second question, or the third question, was about like activity that happened, but we don't have like a record of sort of. Yeah, unless we have like, for tax purposes, we need to know all your transactions. So that's every time your balance of some asset changed. It went up or it went down. We need to know that it happens. We need to know which asset was affected, and we need to know why it happened as well. If we don't have that data, then there's no way that we can do the tax calculations. So that's a challenge. If we don't have the information about what's happened, then we obviously can't do the tax calculations for it. Usually you have to do a more manual process then.
Just a real quick question on your plans. For like the normal person, do they have to go for like the super high complex plan that includes all the fancy algorithms? Like what can the base person get away with for tax purposes?
Yeah. Yeah, it's really easy. Like basically everyone can be covered by our budget plan. That's $59. The annual subscription, 10,000 transactions. You can import all the data, we'll do the calculations, you can generate that report, and you can use that to declare. You don't need to, like our advanced, like the tax optimization, if you have a larger portfolio, it might make more sense. That's like our higher tier plan. You don't have to use it. You only have to use it if it's going to actually help you save something.
Hello again.
Yeah.
So my next question is, if you invested in some kind of cryptocurrency and it turned out to be a scam,
Yeah.
and you lost all your money, is there any way that can be offset by any gains you've made in any other investments?
Yeah, good question. Very common question, actually. Yeah, it's a good one. Yeah, actually, this is a great question because it has affected a lot of people this year or this last financial year that's passed. So people who had something on FTX, for example, maybe on Celsius, BlockFi, any of these platforms which had went into administration rights or insolvent. I might talk about that separately, but yeah, if you've made a loss, so let's say your cryptocurrency you had was stolen, or you lost access to the wallet for the keys, for example, or it was like in a scam, usually there's some way for that to be a CGT event. So that will be a disposal, or there's something that you can do to realize that, and then you can claim that loss. So the answer is like yes, if you've lost the crypto or it's been subject to a scam, there should be some mechanism for you to claim that as a loss. If you are investing in crypto for investment purpose, it would be a capital loss. You can use that to offset your other capital gains. I might just quickly touch on, because most of you have like maybe FTX or something like that, it's really common. FTX is in like an administration process, they're in bankruptcy. We don't know yet if your crypto is lost, all of it, or whether you're going to get something back. Until there's some finalization around that, so like the administrator comes back and says, hey, you're only going to get this much back, so then we know how much you've lost, you can't actually claim that. So you have to wait until that process has finished.
I'm not new to your coverage, but say you invest where you've got traders who trade for you, you pay a certain amount of money, it goes into a pool, pay crypto, then you get dividend that comes back to you in crypto. But you never actually do the trading yourself. Is that kind of something?
Okay, the question was like, you've invested or you've sort of provided your money to someone else to trade for you and you're getting some returns from that. This is always going to be really specific to what arrangement that you've entered. So if you went to a tax professional, they're going to ask you, for example, give us the contract, for example, that you actually entered into, and then they have to analyze it to understand what's happening. It's hard to know without doing that, like what that arrangement actually is. It could be capital gains and losses, it could be ordinary income. We just don't know until we look at it in more detail.
Melvin lost a bit of weight.
Will it be correct to say that your software deals only with one type of capital? That your software deals only with one type of capital?
One type of? Yeah. One type of
Capital.
Because you know, taxation office never allow you capital of one thing in order to repeat losses with another type of capital. So will it be correct to say that your software is only crypto? That's all. That's when it starts, that's when it's ends. Because all the rest actually too ambitious to say that it is.
Okay. Take a shot. Get the question? Yeah. Okay, I think I got the question. It's about maybe the scope of our software and what we do. So Syla is specifically for your crypto investments only. If you have other investments like in shares, in property, anything else where you earn income or capital gains, you're not going to use Syla to calculate those tax outcomes. You're only going to use Syla to calculate the capital gains and losses as well as sources of ordinary income and any expenses that are related to your cryptocurrency. So your exchanges and wallets, you can import into Syla, generate the report, and then at some point you have to combine that with your other sources of income as well. So, if you have some shares that you sold, you need to work out the gains and losses from those and combine the information together when you declare.
Another taxable event / DeFi question.
Okay.
If you were to put your cryptocurrency, Ethereum, up, say, as collateral and then lend against that,
Yeah.
is that a taxable event? That's the first part of the question.
Yeah.
And if it's not a taxable event, would it then become a taxable event if you then got liquidated later? So, for example, you could lend to 90% of your value of your collateral, which would be then lent, and then it got liquidated if it went down, or if it went up, obviously then you could then benefit from the value of the cryptocurrency going up. Does that make sense? Question?
Yeah, enough. Yeah, I can try and answer a little. Okay, the tax questions are starting to get a little bit more complicated. So the question is around sort of like some of these DeFi protocols and what are the tax implications of those. I think specifically it was about like you sort of like lend, like you sort of put your crypto out as collateral, so someone can maybe borrow against it or you're borrowing against it, whatever it is. The truth is there's not a lot of guidance around those, and some of them are quite specific to the protocol as well. So once again, we would want to look at it to understand what's happening. The core part is whether you, let's say you put that crypto in as collateral, do you still have ownership of it, or is it gone now from your ownership? Because if you no longer own it, almost undoubtedly it's going to be a CGT event, and that's what triggers the calculation of the capital gains or losses. If you still own it though, then there is no capital gain or loss that you have to calculate. It's still yours, you haven't actually sold it. So that's usually what it comes down to. In a lot of those protocols though, you do lose ownership, so it does trigger a CGT event. It just depends, exactly how it works.
One of the tough questions. This one's probably really easy,
Okay.
but there probably was a little bit of uncertainty in the past about this, and that is when you take your crypto from one wallet, let's just say an exchange like crypto.com or whatever, and then you put it into like a Trezor or like something else, or when you send USDT from like one wallet on your MetaMask to another.
Yeah.
Is that a CGT event? I'd love your thoughts. Thank you.
Okay.
Well, we are supposed to be here last.
I can maybe just keep the answer simple and say no, it's not almost never a CGT event, but it could be. It comes down to the same question. I should mention the question out loud, sorry. So if you have your crypto in your exchange and you send it to your wallet, or you put it in a wallet, send it to another wallet, and you're just transferring your crypto around. Provided you still have ownership and it was yours to begin with, then it's still yours. You haven't disposed of it, so there is no CGT.
This is something I've always wondered, because when you do this stuff, there's always like gas fees and all that stuff.
Yeah.
Can we claim those gas fees as like almost like what we do with bank fees?
Mm-hmm.
Nice.
Yeah. Yeah, the question is around tax of the gas fees or whether you can claim them. So if you send your crypto on chain, or even if you withdraw from a platform and you pay a withdrawal fee, if the fee you pay is related to your investment activity, you should be able to claim it in some way. Usually, you might be able to claim it as a deductible expense, which is great. It just offsets basically your income for the year. Or you may have to capitalize it into the cost base of the asset. But in one way or another, you should be able to claim it.
This is like the most popular.
Yeah. You made it sexy, Nick.
Lots of questions.
Yeah.
Yeah.
Hey,
Yeah.
a question. When I link the country for excessive amount of time, so I'm no longer tax resident, right?
Uh-huh.
And
Okay.
when I come back like in a 7, 9 month and need to do my taxes, how does it take this into the account? Will it benefit of it or no?
Yeah. Okay, we are getting harder
Thank
now.
you.
Sent to test you.
Yeah, it is. All right. All right, the question is on international tax residency. Okay, so we don't do this in our software directly, but if you talk to your tax advisor, this is what they would advise on your tax residency status. If you're not a taxpayer of Australia, so if you're not an Australian taxpayer, usually there's no tax that you have to pay here. But the trick is, like, have you actually ceased your tax residency? So this is where you talk to an advisor to see have you actually ceased your tax residency here. Because normally, if you're an Australian taxpayer now, and then you go overseas, say for 7 months, you're probably still considered an Australian taxpayer. Even worse, yeah. You have to actually permanently leave the country to cease your tax residency. If you are an Australian taxpayer and you're overseas and working, you still have to declare it in Australia. The worldwide income has to be declared in Australia.
This is good. I mean, like, I was not hoping.
Exceeded
Do you
expectations.
support transfers from another tax reporting provider? If so, what issues do you foresee any issues by transferring from another provider to Syla?
Right.
And do you provide any support with that? So that's question number one. And second question, I'm taking on behalf of someone else. I'm sure it's a common question that many people ask. How does the ATO know that
right.
you sold
Good
crypto
question. Yeah.
or an exchange or a
question.
BTC? Does, I guess in that regard, does ATO have any technology
Yes.
or do they request any data from exchanges to, see that information?
Cool. Yeah. Yeah. Okay, two great questions. The first question is around, like, you used a previous software in the past and now you want to use Syla. Yeah, there's a couple of ways that you can do that. The way we normally recommend, if it's possible, is just re-import everything into Syla. You have access to all your historical years, like the one subscription, you can do all your past years as well. So that's the recommended way. You just import everything. You can adjust the tax settings for the prior years if you use something besides lowest tax first outright. That's the way we normally recommend it, because the other ways are a bit more, we don't have a specific import for those providers yet. It's something that's coming. The second question is, does the ATO, how does the ATO actually know about the crypto investments? Just asking for a friend, right? They know about some of your crypto investments. The way that the way that ATO gets the data is from the crypto exchanges. So if you've used an Australian crypto exchange, that's a registered digital currency exchange, it's got a DCE, there's a license number. All those crypto exchanges, ATO runs like a data sharing program with them. So they actually go out to the exchange and say, hey, just give us all the users that have been on your platform, some of their transaction information. And because you've done your KYC right, they know who you are, you know you're on that platform. And then what happens is when you do your tax return, it will pop up and say, hey, we know you have cryptocurrency investments that you sold. You need to calculate those and declare them. If you use a tax agent, they'll also see that pop up, and that's why they ask you, hey, can you please do your exports and give them to me so that we can declare the crypto. Regardless of whether they can see it or not, the legal responsibility is still there. That's really clear. So, if you have, sources of capital gains, you do have to declare them in Australia. Don't think they do a lot of on-chain sort of tracking at the moment, but just remember that all that activity is permanent and immutable. It's not that hard to link it back to your exchange to work out where it came from. So if you want that sort of peace of mind, usually it's easier just to declare it. If you do make it big, right, you cash out millions, the ATO does, put that in a bank account. They're going to ask, where's all this unexplained wealth come from? And that's also where they'll sort of start to identify and dig in. So usually recommended just to, declare the information, but that's where they get it from.
Sorry. I thought I just add a quick note on this one. Just for anyone, just because you do crypto trading doesn't mean you can hide crypto. At Blockstars, we do crypto forensics. So we do get asked to track crypto for people who the government believes that has crypto and not declaring.
There you go.
So please, 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 if you are in crypto, please don't think that's a way of hiding your crypto. So, all right, Melvin.
Hello. So two questions actually. So I have two things that I trade through. So I trade through my personal self, and then I have a trust. So it's like, is there any way to connect them two, or is it just be two separate kind of thing? You just have to get two separate licenses, and then going forward, do I then just roll it over every year? Like every year there's like a separate payment, and then I just have to pick up the next year, and it's already connected, and I don't have to do it again. Is this already connected?
Last question after this, Last question.
Okay, the question is about like sort of having multiple entities that you trade cryptocurrency under. So you as an individual can have cryptocurrency, but you might also establish like a company, or in this example, you might establish a discretionary trust or a family trust, you might have heard it referred to. This is a whole different tax entity, and that activity is sort of isolated in some way from what happens under you as an individual. If you want to do both those entities in Syla, you would have two separate accounts, one for each. Then we can do the report for you as an individual and the report for you as a trust.
Last question?
And, yeah, the payment just rolls over. Yeah.
One more? Okay, last one. Last question.
So it's related to the last thing we were talking about. Let's say that you had mined crypto, or my friend had mined crypto, and he also owns a company. What's the best way of doing the tax? Is it that, because there's no KYC yet, when you do the KYC, you can KYC as a company or as an individual.
Right.
So does the tax department favour the company or the individual?
Okay.
No pressure.
Sorry?
No pressure.
All right, no problem. It's like not like a best way to do your tax. There's usually like the required way that you have to do it. If the mining activity was done under the company, then the company should record those transactions, calculate the tax outcomes, and declare it under the company. If the mining activity happened under you as an individual, then you as an individual should calculate those tax outcomes and declare it under you as an individual. There's no like preference between one or the other. It's just like what happened is how it should be declared. If you thought about it before you started the mining activity, then that's where we do structuring. So we ask that question. Is it better to do the activity under a company, or is it better to do under an individual, or is it better to do under a trust, for example, or even potentially is it better to do under a self-managed super fund? Because each of those is a different tax environment and have different tax outcomes, and sometimes there's benefits and downsides. But you have to do that before you start, not after it's already happened. So once it's already happened, you just have to declare how it happens.
All right, it's done. Finish.
All right. Thank you very much, everyone. If you have any questions after, please raise your hands.
That's wonderful. Thank you. That was so insightful. Hearing all about Syla. And don't forget there is that 30% discount if you'd like to take that offer up. I'd just like to invite Cozzy for a few final words from Blockstars Technology.
Awesome. Thank you, Danielle. And first of all, Nick, thank you so much. Syla, I think Mariana is here as well. She's here.
Yeah.
So they are from the team Syla, and thank you so much for coming down and sharing your knowledge and your platform with the Blockstars community. I think that's so much. We never had this much interest in any of our meetups before. So obviously people love tax, right? You didn't make it sexy. So thank you so much, guys. Oh, Melvin loves it. All right, guys, thank you so much. So we just want to say thank you again for the team. And guys, thank you so much for coming down. And now it's time to have fun. Yeah, thank you.